Okay, something really strange is happening in the world of finance right now. There's this massive wave of buying that's pushing markets to, well, dizzying new heights. But here's the thing, it's not being driven by the usual suspects. So, what's really going on behind the scenes? So here's the puzzle we're looking at. You've got the US and Japanese stock markets literally on opposite sides of the planet, and they are both on an absolute tear, hitting record after record. And this isn't some slow, steady climb. Nope. This is what traders call a melt-up, a sudden, sharp, and, let's be honest, often kind of irrational surge. So the big question, the one we're here to answer, is why? Why is this happening in two very different economies at the exact same time? This can't be a coincidence. Think of this as a detective story. We're about to pull back the curtain and uncover the hidden machinery that's driving this whole thing. Let's start our investigation in the United States. Now, you'd probably think a rally this huge is all about greed, right? Or maybe wild optimism, but the truth is, it's actually way more interesting. It's being driven by a very specific and very powerful kind of fear. Let me introduce you to our main suspect, a concept called FORT. That's FORT, and it stands for fear of right tail. Now, right tail is just some financial jargon for an unexpected, massive upward explosion in the market. So this isn't the fear of losing money. No, this is a professional, career-driven anxiety, the terror of being the only one left on the sidelines while everyone else is making a fortune. And this quote from Nomura's Charlie McElligott just nails it. He talks about fund managers being forced to chase the rally, not because they're true believers, but because of pure career anxiety. Just imagine for a second. You know that if you underperform, if you miss this boat, you could be out of a job. That kind of fear, that is an incredibly powerful motivator. Okay, so we've got our motive, fear. But how does a feeling, an emotion, actually translate into billions and billions of dollars, pushing the market higher and higher? Well, for that, we need to look inside the engine room of the modern market. And that engine is something called a gamma squeeze. Now, I know it sounds super complicated, but here's a really simple way to think about it. Imagine a ticket scalper who sold a ton of tickets for a huge concert before they even had them, betting the price would stay low. But then, bam, a superstar is announced as a surprise guest. Demand explodes, prices go through the roof, and now that scalper is forced to buy tickets at any price just to cover their promises. That desperate, forced buying just sends prices even higher. That, my friends, is a gamma squeeze. And this is exactly how that feedback loop gets going. It all starts with step one, a huge wave of traders buying these short-term call options. This puts the big Wall Street dealers who sell them in a really tough spot. That's step two. So, to protect themselves, which is step three, they have no choice but to buy the actual stocks as the price goes up. And that forced buying is step four. It pushes the price even higher, which just starts the whole crazy cycle all over again. It's a fire that literally feeds itself. And the scale we're talking about here is just staggering. On top of that whole options mess, you have another automated force, leveraged ETFs. Think of these like investment funds on steroids, okay? They're designed to automatically amplify whatever the market does in a day. So if the market goes up 1%, they might be built to go up 2% or even 3%. This automatic rebalancing can create this incredible buying pressure. The source material we looked at estimates that on just one recent day, this system alone forced over $11 billion of buying into the market. Fear might start the fire, but this stuff, this is pure gasoline. All right, now let's hop over to Japan. You might be thinking, okay, this is just some wild American thing. But when we look at Japan's rally, we see something absolutely fascinating. The spark that started it is totally different, but the fire, it's burning in exactly the same way. So in the US, the main driver is this FORT mentality, right? A lot of it is centered around the whole AI frenzy. But in Japan, it's a different story. The rally there is nicknamed the Takaichi trade. It was kicked off by a wave of optimism around a new political administration and its policies. Two completely different triggers, you'd think? Well, not so fast, because under the hood, Japan's market is flashing the exact same weird signal as the US, spot up, vol up. Let me tell you why that is so unusual. Spot is just the market price, and volatility, is basically a measure of fear. Normally, when prices go up, fear goes down. People are happy, they're confident. But here, as prices are screaming higher, fear is also rising. And that is a huge clue that this is not some calm, confident rally. It is the signature of frantic, forced buying. And this table really shows us who's caught in this tidal wave. First, you've got hedge funds who are actually betting against the market. They're now being forced to buy everything back just to cut their losses. Then you have CTAs. These are automated trend-following funds that are already betting big for the market to go up. And finally, you've got foreign investors who are still piling in. It's a total stampede where basically everyone is being forced to buy, creating this powerful one-way street straight up. So, what have we learned from all this? By looking at these two cases, the US and Japan, side by side, we can now piece together the playbook, the anatomy of a modern market melt-up. And this, right here, illustrates the entire story perfectly. You see, it doesn't actually matter what the spark is. It could be FORT in the US, or it could be political optimism in Japan. Once that initial spark is lit, it gets fed into the exact same underlying market machinery. This combination of options hedging, automated funds, and crowded positioning that creates a powerful, self-reinforcing upward spiral. So here's the absolute crucial takeaway. These are not your grandfather's bull markets. Today's rallies are powerful and, frankly, unstable feedback loops. Human emotion, that fear of missing out, it gets picked up and amplified by these automated, systematic trading strategies, which in turn causes more human emotion, and the cycle just keeps repeating. And that leaves us with one final and pretty critical question to think about. This machinery, this whole system, is incredibly powerful on the way up. But it is a two-way street. So if these rallies are built on these intense, self-feeding loops, what in the world happens when they finally reverse? What happens when that fear of missing out turns into a fear of holding on? That's the billion-dollar question, isn't it?